Even if your investment never crashes, it can still quietly bleed to zero. Inflation, hidden fees, bad structuring. Right now, your $100 is under constant attack by forces most investors will never even see coming. This is the full breakdown of the silent wealth killers and why your $100 investment might be worth absolutely nothing by 2030 if you don't know what you're up against. Most people think losing money looks like a red ticker, a market crash, a headline about some company going under. But the truth is far more unsettling. The most dangerous forces destroying your wealth right now don't make headlines. They don't trigger alerts on your phone. They work slowly, invisibly, compounding against you year after year, while your account balance might actually appear to be growing. Today, we're pulling back the curtain on every single one of these forces. By the end, you'll understand exactly how $100, even one that never technically loses money, can be quietly eaten alive by 2030. And more importantly, you'll know what to do about it. Let's start with the biggest and oldest wealth killer of them all. Since 1913, the year the Federal Reserve took control of the United States banking system, the dollar has lost roughly 97% of its purchasing power. Let that sink in. A dollar today would be worth less than 4 cents back then. That's not a typo, not an exaggeration. That is the documented mathematical reality of what's happened to the currency sitting in your wallet right now. And this isn't ancient history, it's accelerating. Research from Truth in Accounting analyzed the damage across 3 generations, and the numbers are devastating. From 1925 to 1975, $100 lost 67% of its purchasing power. Bad enough. But from 1975 to 2025, that same $100 lost 84%. What was once $100 now buys what $16.40 would have bought 50 years ago. Sheila Weinberg, founder and CEO of Truth in Accounting, put it bluntly. These numbers tell a devastating story. The dollar has been consistently devalued across generations. Yet elected officials and media rarely discuss that a $100 Social Security benefit in 1975 has the purchasing power of only $16.40 today. When people hear about inflation, they think about gas prices, groceries. They don't think about what it means for their investments. But inflation is arguably the single most important concept for any investor to understand. Because if you don't account for it, you can feel like you're getting richer while you're actually getting poorer. This brings us to what economists call the strong dollar paradox. You've probably seen the headlines. Dollar strong, markets up, everything fine. But foreign exchange strength is relative. It's just measuring one managed currency against another managed currency. Purchasing power, on the other hand, is absolute. It measures how much bread, how much fuel, how many square feet of housing your money can actually buy. And that number keeps going down. In 2022, inflation hit 6.5%, the highest since 1981. It dropped to 3.8% in 2023 and 2.6% in 2024. The Congressional Budget Office projects it will hover around 2.7% in 2026 before gradually returning to the Fed's 2% target by 2030. Between 2022 and 2030, cumulative price increases are projected to exceed 28%. So right out of the gate, if you put $100 into any investment today, that money needs to grow by at least 28% over the next several years just to maintain the same purchasing power. Not to get richer, just to stay where you are. And that's using the optimistic government projections. What consumers actually feel at the grocery store, at the gas pump, paying rent. It often feels significantly worse. Now layer on top of this the tariff situation. The Federal Reserve estimates that tariffs implemented through November 2025 raised core goods prices by 3.1%. The average tariff rate is currently 10 to 13%, the highest since the 1940s. The Tax Foundation estimates these tariffs resulted in an average tax increase of $1,000 per U.S. household in 2025. And with businesses passing those costs onto consumers and pre-tariff inventory running out, more price hikes are coming through 2026. Inflation isn't just some abstract economic concept. It's a tax, an invisible one, and it never sleeps. But inflation is only the first force working against you. Let's talk about the one the financial industry really doesn't want you to understand. Fees. There's a saying in the investment world: fees are the only guaranteed outcome in investing. Returns fluctuate, markets crash, trends fade. But fees are certain, relentless, and compounding. And that last word is the key: compounding. Most people learn about compound interest as this magical force that grows your money exponentially over time. And it is. Einstein reportedly called it the eighth wonder of the world. But compound interest has an evil twin: compound fees. They work the exact same way, just in reverse, quietly eating your returns year after year after year. Here's a real example. Two investors, both start with $100,000. Both earn 6% annual returns over 20 years. The only difference is their fees. The first is in a mutual fund charging 1.5%. The second is in an ETF charging 0.1%. After 20 years, the first investor has $241,000. The second has $314,000. That's a difference of over $73,000. Same market, same returns, same starting amount. The only difference was a fee that probably seemed trivial when they signed up. Over 30 years, a single percentage point in fees can cost you 25% of your portfolio's entire potential value. And here's where it gets truly insidious. The expense ratio you see on a fund's fact sheet is just the tip of the iceberg. Beneath the surface are invisible costs that never appear on any label. Trading costs from portfolio turnover. Bid-ask spreads every time the fund buys or sells. Tax drag from capital gains distributions you have to pay taxes on, even if you didn't sell anything yourself. These hidden costs can add another 0.5% to 2% in annual drag on your returns, turning what looks like a low-cost fund at 0.75% into something that actually costs 1.5% to 3% per year. At that point, you need to earn 3.5% or more just to break even after fees and inflation. Your money isn't growing. It's running on a treadmill, and the treadmill keeps getting faster. Now, some of you might be thinking, I'll just keep my money in a savings account. No market risk, no fees. Balance goes up every month. Sounds reasonable. It's also a trap. As of May 2026, the national average savings account rate is 0.38%. The FDIC confirmed it. Meanwhile, the Consumer Price Index jumped to 3.8% on an annual basis for April 2026. Your savings account is earning less than 0.5%, while inflation runs nearly 10 times higher. In real terms, that's a negative return of over 3% per year. Your balance goes up, your purchasing power goes down. You feel like you're saving. You're actually losing. There is a difference between traditional big bank savings accounts and high-yield savings accounts. On the same $25,000 balance, over 5 years, a big bank account loses over $3,300 in real purchasing power, while a top high-yield savings account actually gains about $2,500. That's a swing of nearly $6,000 on the exact same starting balance. The account you choose matters enormously, but even the best savings account won't make you wealthy. It's triage. It stops the bleeding. To actually build wealth, you need returns that meaningfully outpace inflation and fees combined. And that means understanding the broader economic environment your money is operating inside. Which brings us to the elephant in the room: the national debt. The Congressional Budget Office projects the federal deficit will hit $1.9 trillion in fiscal year 2026 and grow to $3.1 trillion by 2036. Debt held by the public is expected to rise from 101% of GDP in 2026 to 120% in 2036. That would surpass the previous record set just after World War II. This isn't abstract government accounting. It has direct consequences for your investments. The Peter G. Peterson Foundation found that compared to policies that would stabilize the debt, the current fiscal path will result in 13.6% less private investment by 2035, 17.1% less by 2055. That same trajectory eliminates 1.2 million jobs by 2035. Less investment, fewer jobs, slower growth. That is the backdrop against which your $100 is trying to grow. The CBO warned directly. Rising interest costs increase the risk of a fiscal crisis, a situation where investors lose confidence in U.S. government debt, interest rates spike abruptly, and broader economic disruptions follow. Meanwhile, the stock market itself is flashing warning signs. The S&P 500 breached the historic 7,000 mark in January 2026, but the February fade reignited fears of a bear market. The VIX Volatility Index has been hovering around 27, well above its long-term average of 20, and the Nasdaq slipped into correction territory at the end of Q1. Then there's the Buffett indicator, Warren Buffett's preferred measure of market valuation, comparing total stock market cap to GDP. Buffett himself said, if this ratio approaches 200%, you are playing with fire. As of early 2026, the Buffett indicator stands at 227%, 1/6 higher than what Buffett identified as the fire zone. The dollar itself fell over 9% in 2025. At the start of 2026, the weakening continued as uncertainty in U.S. policy and geopolitical tensions drove investors toward gold, silver, and the Japanese yen. The Fed has held rates steady at 3.5% to 3.75%, but CME FedWatch data from June 2026 shows 70% odds of a rate hike by December. Higher rates mean higher borrowing costs for businesses, slower growth, and more headwinds for your portfolio. So let's bring it all together. Let's trace the journey of your $100 from today to 2030. You invest $100. Inflation runs at roughly 3% annually. Over 8 years, that alone erodes about 28% of your purchasing power. Your $100 now buys what $72 would have bought when you started. But you're also paying fees. A fund with a 1.5% expense ratio compounds to remove another 12 to 15% over the same period. Then there's tax drag. Morningstar estimates this costs the average mutual fund investor 1 to 1.2% of total returns per year. Add hidden costs, trading fees, bid-ask spreads, cash drag, another 0.5 to 2% annually. Stack it all up. Inflation, expense ratios, tax drag, hidden fees. $100 in purchasing power becomes $50 to $60 by 2030, and that's in a scenario where markets deliver positive returns. If we get the kind of correction the Buffett indicator and elevated volatility are warning about, the damage could be far worse. Your $100 didn't crash. It didn't collapse in some dramatic headline-grabbing moment. It just slowly, silently, and methodically had its value drained away by forces most investors never even see. So what do? First, awareness is your most powerful weapon. Most people lose money not because of bad luck, but because of bad structure. They pay fees they don't know about. They hold cash in accounts that guarantee negative real returns. They confuse feeling wealthy with actually being wealthy. Second, minimize fees ruthlessly. The difference between a 1.5% expense ratio and a 0.1% expense ratio isn't small. Over a lifetime of investing, It's the difference between retiring comfortably and retiring with regrets. Look beyond the number they show you. Understand turnover costs, tax efficiency, and the charges buried in the fine print. Third, never confuse nominal returns with real returns. If your investment gains 5%, but inflation is 3%, and fees take 1.5%, your real return is 0.5%. You barely moved. Compound interest only works in your favor when you're calculating real returns, not the number your brokerage puts on the screen. Fourth, respect the macro environment. Rising debt, elevated valuations, geopolitical uncertainty, a weakening dollar. These aren't reasons to panic. They're reasons to be thoughtful, diversified, and strategic about where and how you deploy your capital. The dollar has lost 97% of its purchasing power since 1913. Fees can silently consume a quarter of your portfolio over a lifetime. The national debt is on a trajectory never before seen in American history, and your savings account is almost certainly losing you money in real terms, right now, today, as you watch this. These aren't predictions. These aren't scare tactics. These are documented, measurable, mathematical realities. The forces eroding your wealth don't need a market crash to do their work. They just need you to not pay attention. Now you are. And that changes everything. And hey, if you made it this far, you already think differently than most people. Most people scroll past this stuff. You didn't. That's the difference between building wealth slowly and watching it disappear quietly. If you want more of this, the real numbers, the hidden mechanics, the things nobody's putting in headlines, hit subscribe. We drop this kind of breakdown regularly on The Lazy Wealth. That's what we are all about.